Hello class, this is your instructor, Mrs. Jordan, and we're going to go over the Module 1 activities or information for Module 1. Before we get started, I want to strongly encourage each student to read chapters 1 and 2. It's better for students to read the chapter and then listen to the lecture for clarity than to listen to the lecture and skim through the chapter, because I don't cover every single thing in the chapter. If I did, then what would be the point of having a book, and I would just be basically reading it to you. My lectures are really to hit up on the highlights of the chapter or learning module and to help unpackage the challenging concepts. But you have to read the information first to understand or to acknowledge what areas you're having trouble with. So again, please read the chapter first. If you haven't done it, stop now, read the chapter first, and then come and listen to the various lecture sections. That way you don't have to listen to each and every one. If you've read the chapter and you feel confident in the material, maybe just needing a little bit more reassurance with the journal entries, then you listen to that specific lecture section or segment. You don't have to listen to each and every lecture segment. Listen to the ones that will help you to understand the concepts that you really just couldn't grasp as you were going through. So, with that being said, let's get started. It's amazing how much material you will cover in chapter 1 and 2. It's quite a lot. So the first thing that we want to talk about is accounting. What is accounting? Some say it's the language of business. Some say it's a system. Some say it's a process. It can be many different things to many different people. But we're going to focus on the one area that really encompasses what accounting is. Accounting is a system. Accounting is a system that does what? What do systems do? When I think of a system, the first system that I immediately think of is the circulatory system in a human body. And I think that's really a great example of what accounting is. It's very similar to the circulatory system in the human body. What does a circulatory system in the human body do? It transports oxygen, red blood cells, platelets, and any other material that is needed to the different systems and the different parts of the body. It's kind of like a travel, a highway, so to speak. Of food, nutrients, water, your white blood cells, all of these things travel through the circulatory system. Without the circulatory system, the various parts of your body would not be fed, it would not be hydrated, they wouldn't be able to communicate, because of course in the blood system we have hormones and proteins cycling through that system that communicates to the rest of the body, the whole body. And so in the same way, the accounting system is a system that communicates. It identifies business transactions and then records and stores that information so that we can later communicate it to our users. So first, it is a system that identifies. Identifies what? It identifies business transactions. Not every transaction that a business takes part in is considered a functioning, relevant business transaction. For instance, if a business decides to close on a holiday, that's not necessarily a business transaction that I, as an accountant, or even users, external or internal, have to take note of. It's just something that the company or the business decided to do. However, on the other hand, if that same company decides to purchase a service vehicle, well, then that is a business transaction, because that means many different things. It impacts our assets, what we own. It impacts our ability to earn revenue in the future. And it also impacts our expenses that we're going to incur to maintain that particular vehicle. So we have to know and be able to identify what transactions are relevant business transactions. Then after we've identified the business transaction, we want to glean the information. What did we learn from this business transaction? And we want to record it. We want to show what happened when we purchased this service vehicle. What took place? Well, cash had to go out to purchase it, and then we had to show that we now own a vehicle. So we record that activity, and then we need to store that activity, that information from that business activity. Why? We don't want to forget. We don't want to forget on May the 26th, we purchased a service vehicle for our business. That's very important for future reporting purposes. And next, we want to be able to, in the future, at any time necessary, be able to communicate those business transactions to our internal and external users. Now, that seems simple enough, and if we could, many of us would want to stop right there. But we can't, because although I have identified, recorded, and stored and communicated my business transactions, that doesn't mean that what I've identified, recorded, stored, and communicated is accurate, that it's relevant, that it's useful, that it means anything to anybody. So what I have to do, on top of identifying and recording, storing, and communicating those business activities, those transactions, I have to be able to ensure that those transactions are relevant, that they are reliable, that they are comparable, and that they are consistent. Well, Mrs. Jordan, why does that even matter? Well, I'll tell you. If the information that I'm identifying, recording, storing, and communicating to my users, and let's say the user in particular is an investor, if it's not relevant to him, guess what? He will overlook our company as a potential investment opportunity for him. If the information for him is not reliable, which indicates that I have told a lie, if what I've recorded was a figment of my imagination, then he can no longer trust that particular company as a potential investing opportunity for him. If the information, the transaction information that I've identified, recorded, stored, and communicate to that investor, potential investor, is not comparable, then he will then question our data, our revenue, our earnings, because it's not comparable to other companies in that very same industry. For example, if he was in a valley of decision on whether he wanted to invest in BJ's, you guys probably don't know what BJ's is. It is a warehouse store. They have it in Georgia, and they have it in Florida, and much of the places on the East Coast. I don't know why it's not here. But we have BJ's, we have Costco, we have Sam's. So if he wanted to say, well, which company is better over the other, I want to make sure, and he wants to make sure, that when he's looking at the information that's being presented to him, that it's comparable. And that doesn't mean that each of the companies have to have the same data, the same earnings, and all the other wonderful stuff. But we shouldn't have one company just really just out in the field somewhere, because that is a sign that they're just doing something either really, really wrong, or something is just not right there. Then I want to make sure that that information is consistent. Okay? And why does it have to be consistent? Well, if the information that I am identifying, recording, storing, and communicating is ongoing, so every year I pay taxes, or every year I purchase supplies, or every year I pay my salaried workers, or every year we have maintenance on the building or the service vehicle. If that information is not consistently recorded and stored the same way every accounting period, then someone's going to question it. They're cooking the books. Something is not right over there. So we have to be very, very mindful of these things. And so it's my job as an accountant to make sure that the information is relevant, reliable, comparable, and consistent. For who and why? Well, guess what? Remember, I've got to communicate this information. And how do I communicate business activities? I communicate them through the financial statements, our financial reports. There's an assortment of financial reports that are out there, but the four that we focus on here in accounting are the financial statements. And they are the income statement, some call it the profit and loss statement. They are the statement of retained earnings, or the statement of stockholders' equity. They are the balance sheet and the statement of cash flow. These are the four financial statements that we're going to talk about in this course and in the following course, Business 242, which is Principles of Accounting 2. So these are the reports, these are the communication devices that a company issues every year so that its users, whether they're internal as management, VPs, and business officers, or the external users such as banks, the federal government, potential investors, their own creditors, the ability to see the health and the wealth and the viability of that particular company. And why would those users want to know this information? So they know how to interact with us. Do they want to invest with us? Do they want to give us a loan? Do they want us to buy anything from them? Because my company may not have the ability to pay our bills on time. And so this is why, as an accountant, it's my job to do these things properly in a decent order so that the business looks well and we are interacting in a healthy manner with those in our industries and in our local economy and even our national economy. So how do I do this? Again, we could stop right here and many of you would be happy, but I can't, because there's another layer here that we have to be mindful of. And that layer is the guiding hand. It is the accounting, generally accepted accounting principles. Let me lower this a little bit. And these principles are not laws, although over the past several years we have treated our principles as laws, and many would arguably say that this is what has caused much of our financial and economic challenges in these United States over the past 20 years. Nevertheless, these are generally accepted accounting principles. These are more of guidelines and principles, ethical principles, that we are admonished to uphold as accountants to make sure that as we're identifying, recording, storing, and communicating the information from the business transactions, that information is relevant, reliable, comparable, and consistent. So for GAAP, there are hundreds of different principles, assumptions, and constraints that are listed as a part of GAAP that guides my hand as an accountant. I'm not going to go through each and every one of them, but I want to highlight a few of them that we're going to run into over the course of the next 9 weeks and potentially prepare you for Principles of Accounting 2. The first one that we have here is the matching principle. Okay? And the matching principle really just says, listen guys, if I have expenses and I have revenue for 2014, then those expenses and revenues must be reported in 2014. In other words, I should not be reporting 2014 revenue and expenses in 2015. Because why? Well, because many of you, well, I hope you guys know that you have to have expenses before you generate revenue. If I don't have expenses, then I cannot generate revenue. Case in point, I cannot go down to Bridge Street market myself as a dentist and try to get clients or patients for my dentist practice if I haven't already spent money on a lease for my office, if I haven't already hired my employees, if I haven't spent money buying my equipment, if I haven't even a card to hand out, a business card to hand out to potential patients, if I don't have an internet, if I don't have a phone for them to call me on. I can't walk around and say, hey, Sally Sue, would you like to be my patient, or would you like for me to be your dentist? And by the way, I need you to prepay my services because I need your money now, your revenue for my business now, in order for me to pay a lease and to have chairs and to, get utilities on at my practice, blah, blah, blah. I can't do that. I have to incur all those things first and then advertise and bring in people. So that's really what the matching principle is emphasizing and forcing our hand to do, to make sure that we're not having any crazy people out there trying to record it as the opposite and make themselves look good, because that's just not natural and it's not realistic. The next thing that we have is the cost principle. And they talk about this in the chapter 1 section of the textbook. And really what the cost principle says is, listen, whenever a company goes out and purchases an asset, we must record that asset for what we purchased it for. So whatever costs that were involved in purchasing that vehicle, that building, that piece of land, and that piece of equipment, whatever costs that were incurred in order to acquisition or purchase that asset must be the same amount that we record and store in our accounting system. Now, initially you may think, well, that's easy. Why would we have to have a principle for that? Well, you'd be surprised. As many of you will know, some of you may be in real estate, some of you may be in certain industries where as time progresses, the asset may increase in value or decrease in value. Well, accounting says, no, we cannot do that. Even though you may get an estimate or you may get something appraised, and the appraisal says that that particular asset is now worth more than when you first initially purchased it, as an accountant, I would say that's really nice, but I cannot change the value of that asset in the accounting system. And one of the main reasons is that just because someone appraises something for a certain value doesn't mean that that's what I can sell it for. For instance, a house is a great example. For real estate purposes and in other industries or other, disciplines, it is common practice to appraise a home or a building and to say that this building is now worth a set amount of money. However, for accounting purposes, I cannot change that. So you may have purchased a home 10 years ago for $100,000 and you've gotten appraised this year. They're saying now it's $200,000. Well, I cannot change that value because, as we all know, once the for sale sign goes on the property for that home, that house may sell below $200,000 or it may sell for more than $200,000, depending on where you're living and the condition of the home. In California, it's common practice for when a house goes for sale out there that you bid up. So if someone says this house is worth $200,000, when a person is interested in purchasing that home, they'll say, well, I'll pay $210,000, and then the next person will bid in and say, well, I'll pay $215,000. Here in Alabama, that's not common practice. Here we'll say, okay, the house is for $200,000. Well, I'll tell them that I'll buy it for $199,000 or $195,000. And so different places and things require different things and have different practices. So therefore, we have to stick with the cost principle. Oddly enough, the cost principle is one of the principles that was ignored during the early 2000s, and that's why when we had the housing bubble, everything went to pot because people were appraising 100,000 homes at $500,000 and $750,000, all because of demand, not because that was the true value of the home. So we all know how that ended up. All right, so next we have the revenue recognition principle. And this principle just simply states, listen, revenue must be recorded when it is earned, when it takes place. So in other words, going back to the dentist example, if I'm a dentist and, you know, I did a root canal on a client today, and that root canal is about $1,200. Okay, well, that particular client has insurance. So what I do is I make that notation. My business manager then bills the insurance company. Now, as an accountant for that dental office, I would still record that the dentist earned $1,200 today, even though he did not get paid and he's waiting for the insurance to pay him. Why? Because the revenue recognition principle says, listen, he earned it. You cannot unearn what he's done. He's done the work. He did the root canal. He earned revenue today. Now, when he receives the cash to back that revenue is another conversation. But we're not talking about cash, we're talking about revenue. So what we're simply saying is that revenue that is earned must be recorded immediately within the same accounting period that it was earned, not when I receive the cash. Cash is something else, all right? Then we have the business entity assumption, and really this is a very simple assumption that just says, listen, the business is separate from the owners. When we are referring to a business, we're talking about a corporation, so please be mindful of that. The corporation's owners are the stockholders, and the business continues to operate outside of the stockholders, so we don't share bank accounts and we don't share liabilities and all that other wonderful stuff, okay? Then we have the fair value principle. This principle is becoming a hot topic in the accounting world, and not that it just popped up on the scene, but we are, how should I say this, we are taking more stock and value of the fair value principle versus the cost principle. We are now finding that in certain disciplines and for certain accounts, not all accounts, we are being a little bit more liberal in how we record the cost of an asset or even a liability. So we are saying that there are certain accounts that are able to jump out of the cost principle and jump into the fair value principle, meaning that we are able to do that for, let's say, investments. If you purchase an investment, 10 years ago and you purchased it for $300 and now it's $130,000, well, we are encouraged as accountants to report that investment at the fair value, which is the fair market value now, which is $130,000, not keep it on the books at the cost, which was $300. Okay? So in some areas it does make sense to use the fair value principle over the cost principle. Then we have the time period assumption. I always like to say that a company is a non-living being. And what that means is a company does many of the very same things that a human being does. It consumes, it eats, which in our world it consumes, it defecates. Some of you may feel that you have been defecated on by a company. And what I mean by defecating is that I'm talking about environmental practices. There are certain businesses, especially when we're talking about manufacturing companies, that have the ability to defecate and impact the economy and the local environment of wherever it is housed in making business transactions. It can also birth out, it can reproduce. There are several companies that have spin-off companies, or they're what we call the parent companies to another company. So it can do that. It can die. Business can die. Believe it or not, although we do say that a business is supposed to have a long life, but sometimes businesses just die. They file bankruptcy, they liquidate themselves, and they no longer exist. And so pretty much many of the things that a company does is similar to humans. And so Just as humans age and we have birthdays, so does a company. But for a company, we don't call them birthdays, we just call them time periods or accounting periods. And what that means is we take a 12-month span and we say this is the time period for this particular company. Many of us are very familiar with the calendar year, which is January to December. There are some companies whose time period or fiscal year is not necessarily, it does not necessarily follow the calendar year. In other words, we have the federal government, which starts its new year on October 1 and ends September 30th the following year. We have education entities that will start July 1 and end June 30th. So there's an assortment of things how that goes, but every company has to have some sort of time period assumption. We assume that it's operating on a time period, a 12-month time period to be more exact. And then we have cost-benefit constraints. And what that means is, you know, as accountants, our perspective on the world really is very conservative. And so what that means is our go-to in our nature is to say, hey, if the cost is more than the benefit, we do not engage. We do not engage. This is a bad buy. So you have to do what we call a cost-benefit analysis. If the cost of engaging in this activity is more than the benefit, then it's probably not for us. But if the benefit far outweighs any cost that we have to deal with, then it's probably a good activity to find ourselves in. Materiality constraint really just says, listen, although we have these different types of transactions and these things going on in activities in a business, we are constrained by materiality. In other words, if we are a multi-billion-dollar company, a penny here or there that we cannot account for really is not material. It's not material at all. So we have to be wise as far as what we promote as being relevant, in other words. And then lastly, we have conservatism. It's kind of out of my viewing point here, trying to stick it back in for you guys. Conservatism, and what this is just, again, going back to the conservatism of an accountant. You know, the saying goes, do you see the glass half full or half empty? Accountants are traditional pessimists. I don't like that word, it's so negative. We are traditional realists. And the reality is the glass is half empty. So in other words, we want to err on the side of conservatism. So instead of saying, oh, we think that this is going to happen, instead of erring on the side of warm fuzzy things and optimism, we choose to err on the side of pessimism or realism, because if something good does happen, then we're not hurting for it. But if I say something good is going to happen and then the bottom falls out underneath of us, then you cannot recoup for that because you didn't plan for it. It's better to plan for the worst case scenario and then it not happen than to plan for the best case scenario and then that does not happen. So that's really what conservatism is, and so that guides our hands into how we estimate our ending inventory, how we estimate a lot of different things. We choose to estimate on the side of conservatism. So what does this have to do with this whole accounting process? Well, each one of these principles has a direct impact on how I record my transactions. The matching principle and the revenue recognition principle is a definite guidance on how I need to record revenue. There is the, what is the other one? And how I need to record expenses. The cost principle tells me and guides my hand on how I need to record assets that I've purchased. Materiality tells me, okay, what do I need to report? What is really relevant here? The business entity assumption has a lot to do with consistency and comparability. So if I keep my business life for 12 months, and let's say it goes from October 1 to September 30th, well, then I can now compare the years because it's the same time frame. If I am constantly changing my years of operation and what is considered the first of the year and the end of the year, I cannot compare. It's going to mess up my numbers. And it also has to do with consistency, the time period, conservatism's consistency. It also has a lot to do with reliability. Materiality has to do with relevancy. So all of these things and many, many more has a lot to do with what I'm doing and how I'm doing it in my business. So to make the accounting process work, we need some tools. You know, we have that process. How do we move from there? How do we now take that whole process that we have and really make it useful? Well, in order to make it useful, we have to have 3 tools. And I'm going to end with this, and we'll pick back up in another segment. We have 3 tools that are available to us to bring the accounting process to life. Those 3 tools, the first of the 3 is the accounting equation. The accounting equation helps us to keep, helps us to monitor how the transactions impact the business. Was this business transaction a good thing for the business or a bad thing for the business, and how was it? Then we have another tool that we use as accountants. It's called the T account. This is more of an organizing tool that helps us to organize the increases and decreases in our individual accounts in our business. It helps us to record and store the information from the business activities. And then we have the accounting worksheet. And yes, I did purposefully cross that out. And the reason is that the accounting worksheet is listed in your textbook. However, we're not going to go over those portions of the chapter. So I wanted to list it and show what it represents. It is a tool that we use to help us to complete the process. But it's more of a manual tool. This is not something that you will use in accounting software or even on the job unless you're at a very, very small business where they still continue to use this method, which is slowly dying. But because of technology, we don't have to use the accounting worksheet, and so therefore we're not going to cover that information. But I did want to bring it up and just let you guys be aware of the impact and why it's listed in the textbook and why we're not going to go over it. All right, so I hope this information was helpful to you. I'll see you in the next segment.